Hear the sound okay? If you can, please let me know. All right, I think we're good. All right. Hey, guys. How are you? All right. I saw a lot of you last week in Phoenix, which was awesome. So it's good to see the rest of you here, and, of course, some of you again. So here we go. As we get started, you know that Bill and I are not registered broker-dealers. It means we don't give individualized trading advice or recommendations. Trading does have risk. So, of course, we always want you to paper trade and practice this stuff before you're ever putting your own money at risk. Right? And neither of us have any trading restrictions. All right. All right, so how about this? Should we look at some charts? You guys notice what's going on with the markets today? Yes, please, Scott says. Okay. You're so polite for once. All right, we had a good time. Scott was there last week, and, you know, just kidding on the for once a little bit. All right, here we go. Let's look at e-signal, and let me switch over to this. I'm going to switch this around a little bit. This is my beautiful low-res template for everybody. So we've got a 5-minute chart right here, a daily chart with the yellow background, as you well know. So let's do this. I'm sure you guys have been watching the S&P this morning, and you also know what's happened the last, several days. Last week, obviously, just an awesome sell-off day. I need to move this so I can see all of your questions. Hang on. Let's have a little juggling here. Like that. This will work. So we can get as much space with the charts, and I can still see your questions. It's always a balancing act. How about that? All right, so here's what we're going to do. We're going to look at the S&P, because you guys know what went on last week, I know, with a really spectacular sell-off. And so there we go, somehow. Beautiful. So we know a lot of times, when you have a sell-off like that, especially news-driven, at some point it's going to get overdone. It started looking that way yesterday a little bit with the long wick at the bottom, and the markets have started to retrace a little bit more today. Sometimes retracements, especially in a bearish market, they're just some smaller sideways candles. And so I think you kind of need to be ready for, I think you need to be, kind of ready for anything, obviously, when you're trading and charting. But knowing how the S&P looked yesterday can get you ready for the morning that we had today. Things were bullish on this retracement, but only for a whole 15, 20 minutes. And since that point, the S&P has been moving lower. I sent out a chart watch alert because a lot of stocks had slowed down quite a bit over the last hour or so. And when you have a market that opens, and even in the first hour, you've got two different directions that it's moved, it kind of tells you things aren't exactly what they should be, right? We've got some weird things going on. It's not a big momentum day necessarily, at least not yet. So what we've had on the S&P is a big bullish upswing. Things are retracing and pulling back, and we basically broke below the opening price just for a little bit, and it's now popping back up. And yes, Scott had said, you think it'll shift towards the upper band now? Maybe. It looks like at the very least, if it doesn't go to the upper band, it looks more like the squeeze plate setup, where I expect things to go sideways. Now, will it hit the upper band before it goes sideways? I don't know, but it may. Those of you who were there last week, you'll remember I talked about, in my 2-day class, I talked about the fade into lunch play. Remember that? Just so you know, this is not the pattern that we generally have for the typical fade into the squeeze during lunch. It was an earlier move. When we get that fade into lunch, you have a bigger momentum move in the morning. 15 minutes is not a big momentum move. However, you could take that idea of that fade into lunch And the fade into lunch started a little, it was kind of it was a weird day. What you could have done is recognize that we had all this bullish momentum and it failed right in here. In fact, here, let me back the chart up and you can see it. Let me just jump back right here. Go back to the first 5-minute candle, okay? Okay, so here's our market open. Obviously, the S&P was bullish for the first 5 minutes and things looked great. And the next 5-minute candle, things continued to move. And then the next candle, things are still moving, but you notice the size of the candle bodies here. So the candle bodies are getting smaller and smaller on the S&P. It doesn't mean markets are going to come crashing down into a new downtrend, but it does mean that this bullishness, it's weakening. And you take that and combine it with the kind of market that we are in, and what market are we in? It's certainly not a really bullish market, is it? So things are starting to take a break. When you look at the daily chart of the S&P, obviously we see the selling pressure has been more to the downside. So we see the candles getting smaller and smaller. Once again, candle gets smaller. In fact, it's not really a candle, it's a doji. And this time it moves inside that Bollinger Band. So the previous candles were above the upper band, and now it moves inside the band. So what does that tell you? It shows a lot of weakness, doesn't it? All right, so from this, what you get is a lot of times a pullback and a retracement area. But what would it take? What level would it take for you to think about buying put options? Anybody have any idea? I'm going to give you an idea. How about we look at that last candle body? Or in other words, you got the doji, right? So here's the doji. It's retracing. Now Mike is bringing up another idea. I love it, Mike. Below the third candle body right here. So one of the things that I teach is looking at, and it sounds kind of weird, but how do you know when a stock is done going up? Well, when it starts coming down, right? Okay, I know, genius. But how do you know when it starts coming down? It trades down below the last bullish candle body. And that's what Mike is talking about right here, below that third candle body, that smaller bullish candle body. To me, that's a confirmed bearish entry. Below the doji is an early sign, and that can be used for a bearish retracement trade, but it's a little bit early, and sometimes you'll see things pull back and bounce. So if you want a little extra confirmation, and when a stock is going up, look for it to trade below that last bullish candle body. That has a tendency to tell us that the bullish move might be over and things are starting to pull back. All right. See, sometimes it's the simple ideas that you can turn into a lot of money once you learn how to apply them, right? So there you go. So that's the level that you have a confirmed bearish entry. Well, here we go. On the next candle, it's below the doji, and you see where my crosshair is sitting. It's below that third bullish candle body. That is a place that if you are going to trade, it's that idea of that fade, the fade into lunch, but it's not this, it's different. It's a different variation of that, I guess. It happened a lot earlier. See, right here. And that gives you at least a bearish retracement type entry. And in fact, here, you know what? Let me do this. Let me show you, because if you guys are trading the S&P, you're likely trading the spiders. So let's apply this to the spiders. Okay, so you get your first candle, and you'll see it on the S&P. It'll always look like a big bullish candle, even when it's kind of a gap up. So spiders will reflect the actual gap up. So bullish first candle, second candle, third candle. Candle body's getting smaller. You see the doji. If the spiders drop below that, either the doji, but more confirmation is below the last bullish candle body, you have a place to buy put options right there. Okay, I know my highlighter doesn't stay there for long, but below that bullish candle body, 194.15. On the next candle, this is the breakdown, 194.15. That is the place to buy put options. It's a little bit of that, an early version of the fade into lunch. By the way, you guys that didn't make it, I don't know if you know this, but we had a lot of requests. Both Bill and I and John had a lot of requests from people asking if we could film the DVDs. And honestly, I don't believe we ever gave you a full straight answer because we struggled to find somebody that we thought would do a really good job filming the DVDs in a class like that, and Bill pulled it together and found a really great contact, a guy that does some really neat video work. He ended up recording all of the classes, so all 4 days are on DVD. So he's now frantically working on, editing them, getting them all compiled and getting them together. We've got manuals that are going to be set and ready to go. So that's something you might want to keep your eyes open for, because it is, if you miss this, there's some neat things that we all taught that are new that I think you're going to really like. Bill taught some phenomenal pieces of information, different strategies and things that I think you need to be incorporating. John White did a spectacular job. And then, of course, Markay was absolutely amazing. Or so I tell myself. Right, I'm just kidding. But no, one of the things that I taught, and there was this fade into lunch strategy, which I'm just kidding. All right, anyway. But I have to say I was freaked out, scared to death for the class, but I think it came across pretty well. Feedback was good, so I will let other people talk about it, but I was a nervous wreck for it. I was very happy with the way it turned out. We had a lot of real, I think, clarifying of just some things that maybe a lot of people have been struggling with, just some differences in trading, so I'm happy with it. I will not go so far as to say they're spectacular. I will let somebody else say that. All right, no, it was fun. There you go. Scott says class was excellent. I know. I was a wreck. I was. It's true, Elizabeth. I worked so hard on this class for so long, and then I was a wreck before I started. But it was fun, and I think it came across well. So we'll find out. You can talk to other people. You can ask Bill. But my point was, one of the things I talked about there was a strategy that I haven't really taught more than maybe once or so, and it's this fade into lunch that we often get. You saw it earlier this morning, and it's not surprising given the fact that the markets didn't move very much today. I mean, this 15 minutes of upward movement, you maybe call it 18 minutes of upward movement, it's not that spectacular. And so when things started pulling back right away, that's an area of concern, and it gives us a chance to at least fade or trade this pullback. So you're fading that early bullish move. You're buying put options around on the spiders, 194.15. And so you can see what happens. So the spiders start pulling back. Well, you always want to think ahead of the turn, right? Where are the spiders going to turn? Where are they going to bounce? I don't know exactly. I don't know for sure, but I do know that we want to start watching the 10 moving average and the opening price, because that could potentially be support, right? So as it moves down, you can start tightening your stops to that level. Here it is, sitting at the 10. You can move your stops down, but the very next candle, it closes below the 10 and below the open. And look at what happened. It just paused there for one green doji, and that was it. And now at this point, you start to see a little bit of that pinch that then fails as the spiders continue lower. And they started this downtrending pattern. It would swing up close to the 10 moving average and break down. And now this is the part where it's changed, right? You see what's going on is right here, it traded up to the 10, and instead of breaking down, right here it started, but it bounced around the 10. So that doesn't mean bullish, not when that happens, when the markets have been open a couple of hours. You know what that typically means? It means this could be the part that we're moving into our Bollinger Band pinch. So now notice where the bands have really pinched together quite a bit. So that upper band is low, that lower band is starting to pinch together. This looks more like the squeeze play. So here's what we had. Bullish here, and if you traded it after it breaks down below the doji, that's the exit in bullish trades. Once it drops below that third candle in, that's a place to buy put options. And you've got this downtrend that happens, and now we move into the pinch. We'll see what happens. This might end up being a bearish breakdown out of the pinch as well going forward here, but at least we know things are taking a break. And when you look at the daily chart, what is the daily chart telling you? You guys see what's happening here on the daily chart? It's still a lot of consolidation for the last several days. So we had a sell-off last week on Friday, but Monday and Tuesday, we're still trading, for the most part, inside the trading range of the candle body from Friday. So it'd be nice to see a breakout of that area before we get some real confirmed, some real confirmation that this is all we get, and that all we're going to get as far as a retracement was this morning's gap up and is 15, 20 minutes of bullishness, and then that's it. If that happens, that is going to be awfully bearish. Yeah, Christine is asking, is this a falling three? It is that variation of a falling three, isn't it? So Tom asks, what strike price would you get at the start of the downward movement? So let's talk about that. If you're buying puts below here on the spiders, below that 194.15, because this is, so you've got a couple ways to trade this. Because this is in a downtrending pattern on the daily chart, you could use going in and buying more time on your options. If you're trying to do this as a trending trade, you could buy a couple weeks of time or so on your put options, and you want to buy probably right around at the money, so maybe around those 194 put options to trade this downtrend. Now, and that gives you time to hold through any retracement. Now, on the spiders, think about this. If you were doing something like that, let me switch over here. Let me just switch over the extreme charts just for a second. Okay, so this is how the spiders look. If you enter more of a trending trade, could you consider at this point using a 5 moving average as a stop? What do you think? We're talking an entry at 194.15 this morning. It's traded right up near the 5 and started rolling lower. Everybody see that? The 10 moving average is much too far away to use as a stop, isn't it? So that could give you a bearish entry for a little bit of a trend that we see developing here on the daily chart. So that'd be one way to go. The other thing, do any of you day trade moves like this? Because if you're day trading, you could buy this week's options. And the same thing, you're probably buying the 194s. You wouldn't go much deeper in the money than that. Maybe the 195 put option. So you're right there at the money or slightly in the money. It's going to give you a pretty good delta. Let me just give you an example. Let's look at the options just right now. Right now, the spiders are trading at 192. Let's see if it'll build this. It's going to take forever. But if just to give you an idea of how much those options are, how much the in-the-money option is and the deltas, it's going to be great. Yeah, Jose said sometimes he trades. Else is pulling up. Let me catch up on the questions here. Oh, Mike says it was great, the class. Yeah, I hope you guys liked it. It was so fun for me to teach. So you guys at home, really check out those DVDs. I think you're going to want to get them and review them. I think there were some things that I think all three of us were able to cover that I know you could start applying even right now into your trading that can really help and maybe fix some of the struggles that you may be having. And this is the time of year to do it, because what we have is a really good start to this new year. And often this first quarter is very often the best quarter of the entire year to trade. So you want to make sure you're on top of this and taking advantage of the markets that we have right now, because they're spectacular. All right, so let me show you now. We've got the option chain on the spiders. If I can scroll down. So just to give you an idea of what the at-the-money option is, here we go. So the one, just to give you an example, the stock is trading at 192.11. So if you're looking at the 190, let's look at the 192 puts. Even right now, they're $1.80 by $1.82, 49 delta. To go in the money, you could go the 192.50s. Those are 205 to buy something like the 192.50 option, right? So something like that. Even for a day trade, these options expired this Friday. You've got a 52 delta, and they're a couple of bucks. It's not a huge investment into a trade like that. So it gives you an idea of about how much those options would have been going for over here at the top when things started rolling lower. If you would have bought slightly in the money on those spider puts for options that expired this week, it probably would have been a couple of dollars investment. So that would be your entry. That would be the strike price you would buy, and you could trade this downtrend that we have, just the intraday downtrend. And now, once it starts breaking above the 10 moving average, you probably go back to cash and you're evaluating is this going to break down below the band here, or are we going to move into more of a squeeze play and chop around sideways for a while? I know Brett said, sad I missed you guys last week. I hated it. You're so close, and yet so far. Oh, sorry I didn't get to see you live, but I'm glad you're here today. All right, let's see. Yeah, Tom, you're very nice. He's being very nice. He's saying when you compliment yourself, it's well deserved. It's not bragging. It's a fact and true. That's what I'm going to tell everyone. This is a fact. Oh, he says you're spectacular. Thank you for the answer. Yes, you are so welcome, Tom. Thank you for being so sweet. I really do appreciate it. But you know, it was fun. It's a lot of work to do those classes, but I love it. And I know Bill and John Phil was saying we have so much fun with you guys. We love hanging out. We love doing what we can to help you become better at this business, because this business is spectacular. And the life that you can have if you can get this business down is amazing. And so we want to do anything we can to help you guys get there. So I'm so happy I got to see so many of you last week. I loved it. And for the rest of you, don't miss that education just because you couldn't make it to Phoenix. You take advantage. You'll start seeing the DVDs at some point. I don't even think you could buy them now if you wanted. Bill will know more about that than I do. Maybe you could twist his arm. But they're coming. They're being worked on. I know the manuals are ready to go, and they're going to be available for you. So don't miss it just because you couldn't make it last week. Make sure you take advantage of that. We had a great guy filming them. I think you're going to be really happy. Let's see. Lois asks, on those big gaps down last week, are you buying swing trade puts on the S&P or wait for more confirmation? Oh, good. You're going to be in Trader's Talk tonight. Awesome. You know, we'll work through some of that tonight in Trader's Talk for sure. So you're talking just throughout the week. Yeah, I mean, we can go into this. It's just, let me go back to the S&P for a minute. Just start looking at the index. It was, you know, it was crazy the way the markets moved. But here's the thing. Let me zoom in. You can see this was the last trading day of the year, right here on the right side of the chart. So this is December 31st. On that day, we had to close below all those moving averages. This was a day that I recorded, or no, this was the Trader's Talk, right? That's right, because Christmas was Friday. So this, no, we didn't have Trader's Talk because of Christmas. So this was the day after that chart. I have to remember what was going on. This was our 3-day weekend. Markets were open all day at the end of the year, not Christmas, but New Year's, you know what I mean. So the thing that happens after December 31st, January 1st, whatever you call that, that would be the thing. That would be New Year's. See, it's early in the morning here. All right, so as the year comes to a close, we had a full trading day on Thursday. So we didn't have a Trader's Talk that night because it was New Year's Eve, but I did record a market insight after the holiday, and I said, look, this closed below the moving averages. This is a bearish sign. We know that often the first week of the year, we will, if we're going to see a trend, it often happens the first week of the year. So that was a setup to buy puts if things went down further. So the first trading day of the year, we're here on Monday, and yes, the S&P gap down. Is that a tradable gap? And you know, these are things that I went over again in the class last week. It's right there in the DVDs. This is a tradable gap, and why is that? Because of how far it gapped, and the setup the day before was the first day of the move. So on that gap down, yes, that was tradable. And you know, for trending trades, probably not, because the S&P was still in a super choppy range, right? So then the next day, we have a retracement day. Well, then the next day, there's a little bit of a gap down. Is that still tradable? Absolutely, that is tradable. This is tradable. If they're little small gaps, all of these were tradable. This is even better last Friday because it was a gap up, and then things broke down. All that stuff is tradable. So yeah, if you want in Trader's Talk tonight, I can talk more about gaps that are tradable and gaps that aren't. But every single one of those gaps was tradable last week. Let me see. Oh, Brett, you were sick. I'm so sorry. Hope you're feeling better. All right. Yep, Scott said the student participation last week was awesome. Yeah, it was. The instructor, not so much. Yeah, thank you. I see. And yet he stayed for all 4 days, and we had to drag him out of the class. All right, I know, I love Scott. I can give him a hard time, but then he dishes it back. All right. There you go. Mike said, hey, thanks for the Phoenix class. I sure missed a signal, right? If I ever get that one again, I won't. And that is what is so important. We are all going to miss trades. It happens all the time. The important thing is if you miss a trade, to go back and figure out what it was you missed so that you don't again. And if you have missed taking advantage of this sell-off, there will be other opportunities. There will be ways to trade it. And well, this is what the Traders Talks and the Labs are for. We'll keep working through this and make sure you get that foundation with the DVDs and the let's see, can everybody hear me? It looks like it may have cut out for a minute. All right. So as you saying that's it. The signals, if you miss a signal, go back and back test and practice trade that so that you don't miss it again, because you'll see it again. And that's what we're here to help you for. The free online classes like this, the Traders Talk, the labs, get the foundation through the DVDs, and so that you have that information, and then we'll do in these online classes, we'll help you apply it. Lois says she's looking at the spiders, not the SPX. It's the same thing. The spiders are based on the S&P. So if you look at the SPX, you're trading them together. So you're trading. How do I say this? This SPX is the pure data. You're trading the spiders like the SPX. So on the spiders, the gaps are a little bit bigger, right? Are they still tradable? They are still tradable gaps. Thank you, Scott. Scott's helping me with New Year's and Christmas. All right. Let's see. I had a question here. When I say tradable, does that mean enter at or near the open? No, it means some gaps are too big for you to want to trade. The risk is too big. And so it has to do with the, sometimes what the news is, or lack of news, and then at what price point things are gapping to. Okay, and then what do they do after the first 5-10 minutes? Pamela's asking, what about buying the spider puts that expire on the 22nd? They're still affordable and can keep you in the trade longer. Absolutely. So the only difference is then your exit. Your entry, if you buy a little bit more time, that absolutely is tradable, and it gives you more time to stay in the trade. Go right on. Yeah. Let me make sure I haven't missed any questions here. Oh, Drea, when are you doing an East Coast Next Step? Wish you were coming to DC this month. I so wanted to go to DC. I don't think it's going to work out. It's DC next week. Because here's what's happening. So I was so busy putting this class together that I just didn't know what I could fit into my schedule. Next week, however, Bill got into a bind. He was going to be teaching the Dallas Next Step, and he will no longer be teaching the Dallas Next Step. So I will be teaching Dallas. So it was either cancel or guess what? They have to drag me in. So you guys are stuck with me in Dallas. I will be there for the full 2 days for Dallas. Exactly. No kidding. You poor people in Dallas, don't go there. So I'll be there in Dallas next week. And that's all I'm doing. So obviously then DC didn't work out. I'd love to do it. The next time we're in DC, I will make a point of trying to get there because I haven't been there in a long time. What I know right now as far as my schedule, I will be in Dallas next week teaching the 2-day Next Step. It's just going to be me, so come and hang out because, I'm going to need some help, certainly. I'm hoping, there's a chance to do San Antonio, but that's not confirmed yet. I've got the 5-day in Chicago toward the end of February that I will for sure be teaching. I'll be there with Bill. And that one, obviously, not to miss. And then GSS. So I'll get the rest of my schedule to you. Francis says, Markay, you're now teaching Next Steps. Just from time to time, just like I've been doing in the past, from time to time when there's something going on and things are busy for everybody, I'll step in and teach one or maybe pop in and join them sometimes when I can. All right. Yeah, you mean intraday classes, Pamela? She said, I missed the classes you used to teach online. Yeah, I could go back to teaching some of those. It's a matter of time and fitting it in, right? All right. Yeah, Francis, yeah, I'd love to have you at a next step. Absolutely. Oh, yeah. So DC Jim is asking, what's a 5-day in Chicago? You know, we've done the Traders Intensive 5-day class in Atlanta. Bill and I have taught it in Atlanta every single time. Well, guess what? That's changing. Our next 5-day is going to be, I think it's around the 22nd. Let me make sure, and I'll give you the right date. February 22nd. Yep, it is the week of the 22nd of February, so the fourth week of the month. Bill and I will be teaching our regular Traders Intensive 5-day class, but we're going to be in Chicago at the CBOE. Is there a better place to do that? I mean, we're going to have so many cool things. Obviously, we'll trade overlooking the floor, the CBOE. We will obviously be able to take tours of the floor, and we're going to have some pretty cool market makers coming in to talk to you. Yeah, so this will be awesome. I am so, so, so excited. It's gonna be cool. I think you're gonna love it. It's gonna be just even better than what we've ever done before. We're gonna take what we've done that was so awesome and then just make it even better. I can't wait. All right, so Ron's asking, how can I find low-cost options, nothing over $1? You know, you find stocks that have movement but are lower volatility. You find stocks with a lot of strike prices, like the spiders, and then you find the option. I mean, so obviously, out of the money options will be underneath less than $1, but you're going to have to balance. You don't want to go just. Here's the thing. I don't have a problem with anybody looking for cheaper options, but make sure you're just not buying it because it's cheap. Right, it's like buying the car because it's super cheap and it's going to last for 500 miles and then it falls apart and it's done. You don't want to buy something just because it's cheap. You want to buy something because it makes sense, because the technical's there, and because it's an inexpensive option, but one that you could still make money on. As you get closer to the end of the week, Thursday, Fridays, you'll find a lot more of those with weekly options. Don't just buy them because they're cheap. You buy them because there is a good movement, there's a good trend. There is a reason to trade it. Your reason is not because it's cheap, because that's the fastest way to take, even if you're trying to do that in a small account, that's the fastest way to take a small account to zero. You buy it because it's a good trade, because it makes sense, and because the option is the right option to trade, not just because it's cheap. It's always a balancing act, right? So I like cheap options, but make sure you're buying them not just because they're cheap, but because they're inexpensive and they still have some real value to trading that option. And those are things, we work in those in trader stocks and labs and market insights, where we spend more time on hashing some of those out. But keep coming back. We can look at some of these. Hopefully you can join us in the trader stocks and labs, and we can spend more time finding some things like that. All right, Eugene. Let's see. All right, Dre. Oh, you know how college is? There's a curriculum set up to graduate, and everything is in a specific order. I need one of those, so I'm jumping around. I don't feel like I'm doing it in the right order. Well, I will tell you this, and ask Bill, because I'm going to bring Bill in here in just a second. In my opinion, I believe that you start first learning how to chart and understanding the timing signals in a stock, whether it's sideways, whether it's bullish, whether it's bear, understand some basic candles, and then start learning some basic things about options and bringing in some strategies. And this is where, Bill and John are absolutely spectacular for the strategies. Really, Bill is great in his labs, where he teaches you the chart patterns and the strategies combined together. But to me, that's the order that I think you need to learn these things. Chart first, and you can learn them together as well, but any strategy is going to work if you do it at the right time. How do you know when the right time is? That comes back to the charting. So ask Bill that question as well. I'll have him come in now, and you can talk more about that. But guys, I can't believe how fast time goes. So I'm already over time. So let me, Pam was asking, do you think the market is setting up for a downtrend? It kind of is looking like that, especially depending on where it closes here today. Because look, we had a retracement day, just the beginning of one yesterday. The market started to retrace today. This is a pretty ugly sign when you get a gap up and it cannot continue to go higher, isn't it? So, in fact, even when it was moving into the pinch, I said, we'll see if it pinches or breaks down. It's pushing below the lower band here. All right, so guys, with that, let me do this. Let me bring Bill in. Let's hear from Bill, because I know he's got a lot to say and some great information as well. So thank you for coming and hanging out with us, guys, and we'll see you online in the labs at the Traders Talk tonight. I'll see some of you guys. And so come with your questions, and we'll work through the charting piece tonight, and then I'll see you online with Bill tomorrow. But thanks again, and watch for those DVDs to come out, because I'm telling you, that may really be just the piece that you're missing. All right, thanks, everyone. Take care, happy trading, and I will see you later.
All right, guys, welcome again into Unplugged. Appreciate the opportunity to hang out with you guys and spend some time in here. Some great information that Markay shared. You guys had some really good questions in there, so let me do this. Let me make sure that I've got my screen shared the right way here. There we go. We can clean that up. And let's go in there and address some of those questions that you guys had. Some really good questions. I know some of you guys are in here that are not normally in here, and I think some of that is because we have made available to you, to some of you, the Morning Lab and the Trader Talks, right? Giving you guys an opportunity to come in, spend some time with us. We've got a group of new students that have been hanging out with us in the labs. A bunch of you are going into Markay's Trader Talks. Some of you guys are looking at some of John White's stuff and Rob's stuff. So great opportunity for you guys to learn a ton, and I encourage you to do exactly that. Take full advantage of the information. Somebody asked, what's the process, right? What is the 1, 2, 3 step process that I need to take? Guys, here's what I'm going to lay out there for you, and I'm looking to see who the question came from. But the process is, first and foremost, you got to learn a little bit about reading the stock charts, right? Understand what you are. You are a short-term technical trader. What the pundits on CNBC say doesn't matter. What the earnings per share on a stock is doesn't matter. What a stock is supposed to do doesn't matter. Makes no difference. Right? If you can get just that through your head and learn to read the chart, which this is an example of one right here with Boeing, you're 2/3 of the way there. Then you need to learn how options are priced. And this is really where people fall on their face when it comes to option trading. I heard it earlier. Somebody said, well, I want to buy cheap options. So do I. I want to buy a cheap Mercedes, all right? But they're not out there. There's a reason. So we've got to select an option not because it's cheap, but because it's going to do the job, right? If you if you work on cars and you go out and you buy cheap tools because they're cheap, you're going to end up spending money twice because you're going to break the tools. They suck. Better to get it. Just because it's the right tool and it's a good tool doesn't mean that it has to be expensive. It just means that it has to be the right one. So, I mean, I can go find a cheap option on anything. Watch, check this out. I will prove to you that I can find a cheap option. This is Priceline. Stock's trading at $1,143 a share. You guys who know me know that I'm not one to brag. Yeah, I am. We bought an option, I'm not kidding you, right off that 2-day moving average last week when the stock was at $12.35, and we rode that bad boy all the way down here, $100 in a week. All right, we bought one contract. It was not a $1 option. It was a $12 option. Okay, it became a $60 or $70 option by the end of the week. So what you get what you pay for. But just to prove that you can find a $1 option, I don't care, where the stock is. Hang on a minute. Let me see if I can come up with one here. Let me see if I can find a $1 option out here on Priceline of all stocks. Getting closer. There it is right there. Look at that right there. Even better than $1. 95 cents. The 1070 put option is going for 95 cents. It expires in 4 days. Okay. 1070, meaning that the stock needs to get down to 1069.05 for me to break even. All right, let's see where 1069.05, and let me do this. Let me pull this template off here. Let's go ahead and put Markay's trends back up there, give ourselves a little bit more room, and let's just see 1069.05 is going to be down here, okay? So the stock has to go another, well, about another $100. Okay, right about here. About another $100, and it needs to do it in 3 days, 3.5 days, for you to break even. That's not for you to make money. That's for you to break even. How about that? That sounds awesome, doesn't it? No, that sounds stupid. Why would you buy a $1 option if it's not going to work? But here's the thing, people do it all the time because they're buying, and that's what Markay means by don't buy it because it's cheap, buy it because it'll work. Buy it because it's the right one. We did not make $6,500 of profit in 1 week on one contract by buying a $1 option. We didn't. Okay, Jose says, what about selling it? You could sell it, right? I mean, you could go in here and sell that. Sure, why not? Let's go, let's talk about that. You sell an option down here at the 1060 strike price. You bring in 95 cents. And if the stock moves less than $100, let's say it moves down here and it bounces, stock moves $80, you're going to make 95 cents. Okay? But if you do that on one contract, because that's probably all you're going to be able to afford on the margin, you brought in $950 on a stock that moved $100. So that's ridiculous. Why would you do that? If you think the stock's going to go down, buy a put, but buy the right put. I mean, let's think about this. All right, so the first thing you've got to understand is charting and the importance of charting and how to read the charts and how important it is that you learn to read the charts correctly. Listen with your eyes. Trade what you see, not what you think. You all have heard these things before, but it's critically important for you to identify that. Learn the patterns, learn to identify the patterns, learn to trade on the right edge of the chart, take advantage of the opportunities that are presented, and then learn how options are priced. Okay, so here's the thing. You can sell an option, and that's fine. I don't mind selling options. In fact, one of the strategies that I'm most excited about right now is related to one of the strategies that I taught out in Phoenix, and that is the idea of a calendar spread, where on a calendar spread, we are in the option that the market does not want us, the market maker really would prefer that we not buy on the buy side. And we are in the option that the market maker definitely doesn't want us to sell when we're on the sell side. So we are on the right side of the trade in both the long term and the short term. Very exciting strategy. So I'm not opposed to selling, don't get me wrong, but again, I'm going to sell at the right time for the right reasons. Does that make sense? All right, let's see. Dre says, Bill, help me, tell me the list. I need a new computer, extreme charge, e-signal. My current computer does not support e-signal. You know, it's kind of interesting. The technology these days has allowed us to buy computers for a fraction of what they used to cost. I travel a lot, so I went out and I said, look, I need a computer. It's robust. It's got to be able to do a lot of different things at once, because I might be trading and working on a PowerPoint and doing a conference call while teaching a class. All right, I've done that before. So I had to buy a computer for $700. I got a computer that is absolutely smoking fast, does everything that I need it to do while I'm running eSignal, right? And here's the thing, I got like, you know, kind of the top end of that. You can get computers now for, you know, $300-400 that'll run eSignal just fine. I've got I believe it's an Asus laptop, right? What's important is the RAM, so you want to get as much RAM as you can, and the rest of it, I mean, it's getting to the point where just about any good computer, if you were to walk into Best Buy and buy a computer, you'd probably be just fine. Okay, so there you go. All right, let's see. Just when you need so much, it's like, okay, so Drea says, it was me that asked the question. It's just when you need so much, it's like, do I need to get a new computer because my charting system sucks? So let me just put it to you this way. I mean, if you were, anybody in here ever been to like night school? Anybody ever take extra education and try to make more money? Kevin, the answer to your question is it'll show up just about in time for it to be totally irrelevant. And I'll show you why in a little bit. All right, so if you've taken a night school, if you've taken classes at night, you got to go in there and you're taking a class, right? You're gaining education. You got to pay for the class. Yes. Do you have to pay for the books? Yes. Do you have to pay for you know, gas to and from the university to take the class, unless it's an online class? Yes. Do you have to pay for a new computer if yours isn't got what it takes to do everything? Yes, right? It's an education. There's a lot of things you can invest in, none more important than you. right? Let me say that again. A lot of things you can invest in, ladies and gentlemen. None more important than you. And what we tend to do is we tend to invest in everything but us. Here's how it normally works. Andrea, I'm going to give you a title of a book that I want you to read. It's called The Richest Man in Babylon. Okay, The Richest Man in Babylon. The author's name is Gleason. And what Mr. Gleason talks about in this book, The Richest Man in Babylon, is understanding how money operates, how money flows. It's called currency for a reason, and how best to manage it. Here's what most people do. You get paid, right? You get paid, let's just say that you get paid. I remember when I was in law enforcement, I think at one point, I was making like $3,000 a month, so I'd get paid $1,500 every 2 weeks. It wasn't really $1,500 because Uncle Sam was taking a little bit off the top. That way I wouldn't notice and be compelled to toss all the tea in the Boston Harbor, right? That's how they avoid that situation nowadays. So I really was making about $1,200 every 2 weeks, and I would take that $1,200, and what did I do with it? Yeah, there you go. You pay the bills. All right, so I would pay for the house bill. I would pay the credit card bill. I would pay the car note. I would pay the insurance, and then I would have money left over for other things like gas, food, right? Entertainment. Go out and go to the movie, whatever it was, and a little bit of spending money, right? That's what I used to call it, spending money. And you use that for going to Starbucks and get your caramel macchiato for $6, and do that every single day, right? And so that was what I did, and that's what most people do. How many of you would agree that that's how most people manage their money, right? You get the money, you spend the money, and then you save what's left over. What's left over? When you manage your money that way, what is left over? Nothing. Zero. Zip. You run out of money before you run out of month. Okay? And Drea, I'm telling you, you would be surprised that that is actually not true. And I'm not the only one to say this, guys. I don't care who it is, Dave Ramsey. I don't care if it's Gleason. I don't care who it is. When it comes to managing money, it's always there. It's the order in which you spend it. Here's what happens. If you get your money and spend it and invest what's left over, you'll have nothing left over. But if you will commit to pay yourself first, off of your gross income, you pay yourself 10% first, every paycheck, and that money goes into an investment fund, a bank account that you cannot draw on unless it is for educational, instructional, investment type of ventures. Then what ends up happening is you find a way for the rest of the money. It's money. Try it. George Gleason. There you go. That's correct, Jose. Okay. Jose already looking it up online. I mean, guy's not even going to argue with me. He's not going to. He's just like, boom, got it. Going to read it. Phenomenal book. And here's the thing. The reason it's called The Richest Man in Babylon is that these ideas of money management go back thousands of years. It is absolutely true. If you go and you take 10% of your income and you put it into some bank account, a savings account, and you say, you know what, that money is only going to be used for investment. Investment in what? Investment. Investment means something that you're going to put money in that is going to return money to you. Could that be the DVD set? Absolutely. Could that be attendance to the 5-day? Absolutely. I have talked to people and worked them through this process who have saved up enough money to be able to attend the 5-day Traders Intensive and put themselves on a footing to be able to start converting themselves to looking at trading in the market for their income. But it only happens. Francis says that really works, but we did it with 50%. Well, that would be a lot faster, wouldn't it? It's amazing what happens, guys, when you look. Here's what happens. You spend everything, and then there's nothing left over to invest. If you invest something in the beginning, and then you spend what's left, you just naturally, you're looking at the bank account, you naturally find a way to manage that. You do. It works. It's true. Okay, I didn't know that this was the direction that we're going to go. Andrea says, I bought real estate with mine. Awesome. Okay, it's a great way to invest in real estate, whatever it is. But here's what I'm going to tell you. The one thing that you can always invest in that you can't lose if the real estate market falls, or you can't lose if the stock market was to crash, is education in yourself. You cannot ever have it taken away from you. It's yours forever, and once you learn that skill, you have it forever, and you'll be able to do things like what we talked about in the morning live this morning with some of the calendar spreads. Right? I mean, an amazing opportunity with those calendar spreads, and I'm hesitating. I was going to go through and show. I mean, let me real quick here. Those of you that were in the Apple gap fill trade, look what's going on, right? Just kind of grinding lower and getting closer and closer to filling that gap. Love it. Same thing with Amazon. Same situation, just been fading this lower. Okay, those are some skills. That's what I was going to show you guys. Let me take just a minute here and introduce you guys to something that I taught in Phoenix as part of my Money Matters class, which has now been recorded in a DVD set called Calendar Cash Flow. And it was, it was a great class, had a great time. People learned a lot of cool stuff. But one of the things that I think people were surprised with was to learn a couple of factors here, not just about retirement. I mean, a little bit scary, some of the stuff that I showed people about retirement. Your financial advisor wants you to have $1 million in an account so that you can live off of 4% of what you couldn't afford to live off of in the first place, right? And that's literally what your money managers are wanting you to look at and wanting you to do. Do you know that when you put money into a mutual fund, as an example, let's just use a mutual fund as an example, okay? When you put money into a mutual fund, that the market that your broker, your financial advisor, all they do is tie that money to the S&P, right? How many of you guys knew that was what managers in the money do, money managers do? Very good. Aaron says, I do that with every paycheck and had to reduce other stuff I bought, and it's nice. About 25% of my monthly pay. Wow, check that out. A lot of people buy things they don't need. I love that. That is awesome. So just more confirmation that what I was saying is actually true, and it is. It's not me. I don't make this stuff up, right? I read it. All right. Did you guys know that the annualized average return on the S&P over any 25-year period is about 10%? It's actually over that. If you take any 25-year period in the S&P and you looked at the return on it, it's over 10%. How many of you knew that? Anyone? Anyone know that? Sally says, I knew that. All right, good for you. Julie says, I knew. Well, Julie, you were there. Did you know it before? Steven says, no, didn't know it. Claude says, I knew that. Okay. So a lot of you knew it, all right? So you already know the secret. Here's the thing. If that's the case, and a fund manager just ties a fund, if you start a mutual fund and you tie it to the S&P and you leave it alone for 25 years, you should have an annual return on average of about 8 to 10%. Would you not agree with, how many of you would agree with me that it just makes sense? If the S&P returns 10% over any 25-year period, you could just take your mutual fund and tie it to the S&P and have an 8 to 10% return. How many of you would agree with that? Well, here's the thing. That's exactly what they do. That is exactly what your fund managers do. That's it. That's what they do. Okay? Most mutual funds return 8 to 10% gross. It's not what you get. It's not what you get. You don't get the 8 to 10%. What do you get? Less would be the answer. You get less because these fees, these commissions, these charges, and they don't seem like a lot. Oh, we're only charging you 1% to manage your money for the whole year. All right? 1% compounded over a period of time begins to eat into that, and you end up with less return. And Carolyn says, well, why couldn't we do that? Carolyn, it's like you read my mind. Okay, you're literally paying for their skill to tie your $1 million to the S&P and generate $40,000 of income. Well, check this out. Maybe you could do it with less. What if you bought shares of the Spiders ETF, exactly what Markay was talking about? The Spiders ETF tracks the S&P. You could expect an 8 to 10% growth if you're tying it to the S&P. Yes? All right. So instead, with half the money, $500,000, you buy the Spiders ETF. 8% growth generates that same 40,000 annual growth. You're getting the same growth, the same return, the same bottom line dollars with half the money. And if you left it alone and did nothing, it would grow to over $3.4 million in 25 years, assuming that average 8% return, less than 10. My point is this. If you're broke, it's because you don't know how not to be, and you're probably paying somebody else to help you be broke. But if you invest in the education, this is stuff that folks in Phoenix learn, not only learn, but learn how to do much more with much less. I showed you guys in the lab this morning an example where we're returning around 7.5% on our investment per week. Get the education, learn this stuff. Starts out with reading the charts, ladies and gentlemen, and Markay's DVDs getting ready to come out. In fact, I talked to the gentleman who videoed this stuff for us. Great guy, and he's just cranking away already on the DVDs. We've got a target date in mind. He and I are working on a target date, and I'm trying to incentivize him to get them out a little bit earlier. But guys, when these DVDs come out, you have got to learn how to read the charts. And here's what I'm going to tell you. Don't wait. If you don't have Markay's trend trading DVDs, that is where you need to start. You need to start with the basics. Learn to read the chart. It's there. We're not hiding the information from you. What if I put her DVDs on sale? What if I was to put her DVDs on sale? How many of you guys would be like, oh, well, then I'd buy them then? I mean, I'm not, y'all know how I am, right? I kind of shoot from the hip. It's been known to happen. DC Jim says, do you have her permission? That was great. I don't. I should probably check first, huh? Bob says everyone likes the sale. All right, let's do this. You know what? I'm going to do a flash sale. This is only if you don't have her DVDs, and this is only on her trend trading DVD. Now you guys got me up against the wall here. All right, here's what I'm going to do, because I'm already getting blown up here on my text messages. They're like, what are you doing? What are you doing? What are you doing? Who wants to see a sale on Markay's trend trading DVDs? I'm texting her right now. DC Jim says, I've got them. They're great. Aaron says, yes. Andrea says, do you even have to ask? Rose says, me. Okay, because I'm committed to you guys, and I want you guys to get these. Now understand, the trend trading DVDs are kind of the prerequisite to Markay's trend setting trades DVDs that we shot in Phoenix. Andrea says, if you still have the old ones, you still get the new ones? Yes. All right, y'all ready? 24-hour flash sale. announced right here. You heard it first. Just waiting for a response. I might have to do it without approval. What the heck? We'll do it. What do you guys think? We just do it? 24 hours, right? So I've got noon Central Standard Time right now, 1 p.m. Eastern Standard Time for the next 24 hours. If you guys call in, let's do a 24-hour flash sale, and I'm literally making this stuff up as I go, so I'm going to get myself in trouble here, I'm sure. 50% off. 24 hours only. You guys are like, okay, so a lot of you already have that one. Now this one I don't have. This one I don't have to ask on. What if I did the same thing for my DVDs? My Ultimate Options Trading DVD set off of Trend Trading, Julie. Are you looking for another one, Julie? If you are, let me know. Jim says, I've got them too. They're great. All right, so y'all need to jump on the phone, get the information. You guys are asking for some details now, and I'm literally just putting this out right now as we speak. So 24-hour flash sale. Yes, I have, Patty. Patty says, have you already been drinking? I mean, it was a smoothie. Does that count? It's not like it was wine or anything. It's a little early for that. Well, it's 12:04. 50% off, 24-hour flash sale on Markay's Trend Trading DVDs and on my DVDs. There you go. Anita says, on the SPY example, does that include dividends? No. That's just pure compounded annual growth, Anita. All right, so if you guys have a question on it, there you go, Bloody Mary. That sounds good. Okay. Questions on anything? Anybody got it? You guys want to see what else I had on here? Spiders does not have dividends. Okay, but some mutual funds will tell you that you're getting paid a dividend because you got stocks that are dividend yielding, but you're only getting a small percentage of that, and the other guy's getting the rest of it. Okay. Questions? No? All right, guys, we are out of time. How about that? You guys. So again, really the education here is the important thing, guys. You may not have known this, but literally with half the money. So in other words, if you knew how to do this, you could generate roughly that 8% growth year over year, generating the same $40,000 that your mutual fund manager wants to tell you he can generate for you off of $1 million, so you'd be able to retire. So for the same bottom line income with half the initial investment, and here's the thing, there are ways that you could do it with a whole lot less. Okay, Bob says, what about your new products? Yes, sir. I've got 3 new products. I've got the DVDs that are coming out, calendar cash flow DVDs. Those will be coming out right after Markay's DVD comes out, her new one, the one we recorded in Phoenix. This is the class that I recorded live and in person in Phoenix. I also have a couple new products. One is called Calendar Commentary, which is a market insight type product. Come out a couple times a week as I evaluate, analyze trading candidates for the calendar spread strategy. And then the other is a market commentary where, in a very timely fashion, I will identify opportunities when we will be selling premium to generate weekly cash flow on our calendar spreads. Those are both available right now. Okay. Kevin says, tell us why we won't need conditional orders. So here's the on the stop side, Kevin. They are still working on it, and I am working with them right now, and they're giving me a date I'm not happy with, so I'm not going to tell you what it is yet because I'm leaning on them pretty hard to move that up. But the New York Stock Exchange and NASDAQ are no longer holding stop orders on the floor. So if you put in a stop order it no longer goes to the floor where it's executed. Your stop orders are held at your broker, which could cause a delay and can actually cause a problem executing the stop at a much lower price in the first place. So on the stop side, the conditional and contingent type orders are potentially going to be a problem. Now, we're looking into how the exchanges are doing it. My understanding in talking to Rob is that several of the brokers have said that they will reroute all stop orders to other exchanges that still do offer the stops. So those are some things that we're going to be looking at. Jose says, that referred to any 25-year period in the S&P. Yes, if you take a 25-year period in the S&P, Jose, and you annualize that return over 25 years, you're going to come up somewhere between 8 and 10%. In fact, and most of the 25-year periods is significantly above 10%. Okay. All right, so a lot of information coming out there, guys. Now I got to jump on with some folks on another conference call who have all sent me a text message saying, what are you doing with this flash sale? How are we doing it? And we need to put this out to everybody else. But I wanted you guys to have the first crack at it, so you have the first chance. Carolyn says, does Apple look like it's headed to breaking its 52-week low? Apple looks like it is establishing a potential downtrend. How's that for being pretty non-committal? I don't know how low it's going to go, and I really don't care. I'll just trade it. All right. All right. Other questions? Anybody got any other questions here? $50% off. Yes, Jim. So Judy says, were you using options or stock for the ownership in the S&P? And the answer is yes. In fact, in class, I showed what happens in both cases. Okay, whether you were buying the actual stock, the Spiders ETF, or you were trading options on the Spiders ETF, which of course creates significantly higher rates of return with a lower initial investment and the opportunity in both cases to create weekly cash flow off of selling front week premium. Steven wants to know if I have the 6 numbers to the winning numbers to the Powerball. I do, and it wouldn't do me any favor for me to give them to you because they're on my ticket. Okay, and you'll know because if I win $1.3 billion, you'll be the first people to hear about it. How do we trade options off the stock price now in eSignal? We do it using a delta conversion, Kevin. Let's say, for example, Amazon's trading at 620. I know if it trades up to 621, I would need to get out. If I bought a 50 delta option, that's 50 cents of movement on the option price. I bought the option for $6. I put in a stop for $5.50. I did all that in my head. You should be impressed. Ladies and gentlemen, we have reached. Denise says, will you teach if you win the Powerball? Yes, I will. I promise. I'll stay here and teach if I win the Powerball, because then I'm going to have a I'll have a $1.3 billion hedge fund that I need to manage. Better get the DVDs now. Exactly, Joan. Excellent. Ladies and gentlemen, it has truly been an honor and a privilege to hang out with you guys. Looking forward to doing it again in the very near future. Until then, I wish you guys all the success in the world. Godspeed, God bless, and we will talk to you guys in the very near future.